Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. We have a fantastic show for you today. Right off the top, we have a great interview. I had the pleasure of catching up with three tax experts, and we have a tax expert panel for you off the top of our show this afternoon. They talk about everything from taxes to the Canadian economy, to interest rates, taxation, a fantastic interview, and we get to show it to all of you in its entirety. As well as always, we're going to answer as many questions as that we can, that all of you have with respect to markets and trade and tariffs. A lot of things going on in the world right now, some on the geopolitical side, some on the economic front. So we want to get to as many of those topics as we can for you over the next 45, 50 minutes. So let's put up our topics for our show today. There you have it. Taxes are part of the equation in this uncertain economy. We have a tax panel to discuss. Top three things to consider over the next 5 to 10 business days. As always, these are three things that I think you should think about before you make your investment decisions. How has inflation stayed down despite the tariffs? This is an interesting question because everybody, including myself, we've been waiting to see just how high inflation is going to go, both in Canada, but mostly in the US, right? We've seen inflation or numbers or tariff rates really increase over the last year or so, from about 2.5% to about 15 to 18% tariffs on everything coming into the US. How are they keeping prices stable? We're going to get into that. All eyes were on the Bank of Canada's decision this morning. As many of you may already know, the Bank of Canada cut interest rates by a quarter point. The bank rate was cut by a quarter point. We fully anticipate that all major banks and financial institutions in Canada will follow and cut the prime rate, which is the rate that all of us use to borrow money from our major banks or financial institutions. So look forward to hearing or seeing the banks all cut a quarter point, and that should be reflective in variable rate mortgages, lines of credit, etc. Quick hits. Three things in the news that I think everybody is or maybe have seen or may have been focused on over the last couple of weeks. As always, we're going to chat a bit about them. And finally, we're going to try and take as many questions from you as we can. So if any of you have any questions during the interview with the tax panel, during our show in general, please put it into the chat boxes. We'll be happy to take those questions and perhaps answer them at the end of the show. If we don't get to them, we'll answer them on our next show. So without further ado, let's move on with a fantastic interview with our tax panel. I'd like to welcome Fred O'Riordan of EY Canada, Jake Fuss of the Fraser Institute, and Tim Sesnick of our family office and regular Globe and Mail contributor. We actually did our first tax panel discussion with this esteemed group almost 1 year ago. I can't believe how fast time goes by. September the 18th, 2024. Fred is the national leader, tax policy at EY Canada. He plays a significant thought leadership role with EY Canada on global tax policy and tax controversy, and helps companies to work effectively with CRA. He joined EY in 2010 after a 33-year career in public service, including 20 years with CRA. Welcome back to the show, Fred.
Thank you, Al.
Jake Fuss, Director of Fiscal Studies at the Fraser Institute. His research covers a wide range of policy issues, including government spending, debt, taxation, labor policy, and charitable giving. He's been interviewed by major media across the country and also written commentaries appearing in major Canadian newspapers. Welcome back to the show, Jake.
Thanks for having me on.
And Tim Sesnick is the co-founder and CEO of Our Family Office, Inc., as well as the author of the regular tax and personal finance column in the Globe and Mail. His firm, Our Family Office, provides strategic offerings, wealth advisory services to ultra-high net worth individuals and families. He's also an author with multiple best-selling books. Welcome back to the show, Tim. And thanks for all three of you for joining us again. As I said, it's been 1 year since you were on, and Oh boy, how things have changed
Yeah.
in 1 year. I can't believe it. The world of tariffs is upon us. The world of higher costs is upon us, and lots to talk about. But I thought we'd start off with, I guess, just a general commentary on the Canadian economy from where all three of you sit. Obviously, you talk to clients on a regular basis, you talk to small businesses on a regular basis, and how are they faring? How is it difficult for them right now? What's going on, in your opinion, with respect to the Canadian economy? And we'll start it off with Fred. What are you seeing out there right now?
Sure, Allan. Well, most economic indicators show that the Canadian economy is weakening, and the main cause, as you pointed to, is Trump's tariffs and also all the economic uncertainty that's being created by the Trump administration on the tariff front and other economic and trade policy measures more generally. We see this in particular in certain geographies and sectors that are directly affected by those tariffs, but more generally across the economy as well. And the situation is likely to get worse before it gets better, as the impacts start to be felt upstream and downstream of those affected sectors. In other words, the indirect and induced effects, or the knock-on and spin-off effects from those primary industries that are being affected. The labor market is always the best so-called leading indicator of this, since slowdowns in hiring start first, and then they're followed by layoffs, and then deferred hiring plans, and so on. And we're certainly seeing that in the labor market statistics. Um, Also of concern here is the state of the U.S. economy itself, which is showing signs of weakness as Trump's tariffs start to bite. And generally, as goes the U.S. economy, so goes the Canadian economy, traditionally speaking, and both the upswings and downswings. So although the direct correlation is obviously starting to show some signs of breaking down as the degree to which we're economically integrated starts to fracture and our economies start to decouple somewhat. But it's not a pretty picture, and we see this in particular in U.S. trade numbers, which I was checking the other day. Since December of 2024, imports from Canada into the U.S. have fallen significantly by 14%. Those from Mexico have actually increased slightly by 4%. So that sort of gives you an idea. I'm not sure how well that's appreciated. I mean, we all feel that we're being impacted, by the U.S. tariffs, but Canada in particular is being impacted in the Canadian economy.
That's interesting, yeah, to hear. And I know exports are down by quite a bit. Interesting because USMCA or CUSMA, whichever way you want to call it, pretty much covers about 80 to 90% of what we send to the US. So it's interesting that that you are still seeing these negative effects on our economy. I guess I throw the ball to Tim now. Tim, what are you seeing with your higher net worth clients? A lot of talk is that you tend to see less effects on the higher net worth and probably more effects on the middle class, or those making a wage of a smaller amount. So what are you seeing, Tim, from where you sit?
Well, I think you almost have to distinguish. And when it comes to individuals, there are people who are very tied to businesses that they own and operate, or employees of businesses. And of course, as the economy goes, so goes many of those businesses. And so as things slow down, it affects them significantly. Other individuals maybe who have had liquidity events, they've sold off their businesses, they're just living on investment portfolios. They're faring just fine because they're not so tied to the I guess the success or failure of a particular a business. But I think what I'm seeing is really we're in a transitional phase, it seems, as a country. The tariffs that we're seeing now, which don't seem to be going away and probably won't go away anytime soon. And when CUSMA gets renegotiated next year, I'm sure that's going to become more clear to people. So I think we're in a transitional phase where a lot of the momentum that we kind of saw post-COVID, a lot of the growth that was taking place is really faded away now. The uncertainty around trade and tariffs, we're heading into a new normal. What's that going to look like exactly? But it's starting with a slowdown, obviously, in certain sectors clearly. But I think the uncertainty that's there just causes a lot of slowing down. People are just more cautious, not spending money like they might otherwise, because they're not sure whether their jobs will be safe or what's going to take place. So with many families, nobody's immune to what's taking place more broadly in the economy when they still have their businesses and are employed by these companies.
Yeah, and I agree. You know, I also see a big difference between those that have money in the market and have investments to fall back on versus those that live paycheck to paycheck and unfortunately can't invest. Obviously, those people find it a lot more difficult. Moving to I guess a different question. I'll throw this one to Jake to answer first. Uh, Recently, Prime Minister Carney announced some spending plans, right, to help individuals and businesses cope with the effects of tariffs. You know, he announced some things to help businesses keep their employees employed. He also announced things to help these employees or businesses perhaps learn different skills or trades, I guess, for the jobs of the future, as many people are calling it. And a lot of money is going to be spent. And I guess I'll start off by saying, you know, I think this is a great idea, but to me, you could spend all the money you want as a government, but unless there is an environment that is pro-business, that businesses can thrive in and grow, where they can borrow money to grow, and there's business coming into our country, you know, spending money on training people is great, but it's not going to work if business is not there. So what do you think about you know, the spending initiatives that that Prime Minister has announced recently? Do you agree with them? Do you think they're going to work and be able to help individuals stay employed and perhaps find new employment?
So it's a great question. I mean, I think like you've outlined, a lot of the new spending measures are temporary in nature, and they're meant to really solve the COVID issue, and or not the COVID issue. I mean the tariff issue. Excuse me. And ultimately, they may help at the margin with some people, with some businesses, with some individuals, for instance. But unless we're actually fixing the underlying issues, both on the tariff front, and actually fixing that issue in the long run, they're not going to make a huge difference. And I also think we have to solve our underlying issues in the economy that existed before the tariff issue as well. Going into the tariff situation, we already had weak private sector growth, declining GDP per capita, for instance, a dearth of business investment in the country. So even if we magically kind of solve the tariff issue all of a sudden, we still have these other issues in the economy that we also need to deal with. And so I do think we need to really take a comprehensive review, not only of what we're spending money on and how much we're spending, but also looking at our tax and regulatory environment. There's been some movement on the interprovincial trade front, which is good, but I don't think they've gone quite far enough there. So I do think we need to address a lot of the underlying issues in our economy that kind of existed before the tariff issue, and will likely exist after the tariff issue goes away, whenever that will be. So we do need to attack the tariff issue, but at the same time, I do think we need to have a big rethink of how we're approaching the Canadian economy right now.
What do you think about I guess, the structure or, you know, the infrastructure in terms of, I had Ian Leon, a professor out in Ottawa, and he was saying how he believes that all this is great, but we need to address the underlying issues, as you're saying, which is such as, you know, supply management, need to open up some things, bring some more competition to our country. Perhaps, you know, that would be a good thing. It would lower prices first and foremost for all of us here, like dairy products, etc. Do you think that would work? Do you think is that what you're referring to in terms of underlying issues?
Yeah, I think we need to revisit some of the specific industries in Canada. Supply management is a big one. That's something that's been insulated by politicians across the political spectrum, but it's been a big inhibition towards getting trade deals done with other countries. And it even is a big cost to many consumers at the same time, and only benefiting a very small group of people. But I think, we need to revisit competition in the airline space, telecoms, all of these different sectors that have kind of been not touched for a very long time. And then also needs to have a conversation about, how we're addressing our tax system. We're very uncompetitive compared to other countries. We're spending a significant amount of money, not just at the federal level, but also at the provincial level. This is not a sustainable thing. The regulatory environment is very hard to get infrastructure or energy projects done in this country, and mining and all these other things. So even though the Carney government is starting to prioritize some of those infrastructure projects in terms of fast tracking them, we need a much better regulatory environment. So we're not just picking winners and losers on these infrastructure projects. We're letting the market decide and ultimately getting economic growth and prosperity that way. So I do think we need to have a big rethink of the regulatory, tax, and spending environment and economic environment in Canada.
Yeah, no, makes sense. Makes sense. Fred, what do you think about the spending plans of our federal government? Some of the announcements that Mr. Carney has made recently. Is it going to help small business? Is it going to help, our economy? What do you think?
Well, I think just going back to your initial question, the kind of support programs that he's announced are merited and needed by affected sectors. And what we've heard so far, I'm encouraged in the sense that we're not making the same mistakes, I think, as the previous government made over COVID, where they had overly generous support payments and they weren't income tested and so on and so on. These seem to be targeted, shorter term duration and more transitional in nature to assist those businesses. So in that sense, what we've heard so far, I think, is encouraging. What we've heard so far on your latter questions too, I mean, Prime Minister Carney has said we need to spend more and invest more, and he's talking the talk at this point. At least I would agree with that, and I agree with the points that Jake had raised. I think we'll have to wait for the federal budget to really see exactly what comes out in terms of plans. We at least know the initial infrastructure plans, the Canada Builds plans that were announced yesterday. A little bit of a bit of a disappointment in the sense that for the most part these are projects that are already well underway. So I mean they're picking winners that are already winners. I think the next tranche of projects that we should hear by Grey Cup Day probably will be a little bit more interesting. But I'll pause there, Tim.
Yeah, no,
If I could just add a comment there, I think what Jake and Fred have said is just hits the nail on the head. I think, but here's the way I look at it: if businesses in Canada cannot attract private investment, if business investment in technology and capital investment is not, we're not finding investment in Canada, there's a serious problem. The government can't step in and fill that void. They're not going. The government can provide support, which is important, I think, in the short term. But ultimately, as Jake said, we need to change some structural things that attract more investment to businesses in Canada, so we're not lagging so far behind in our productivity, and that ultimately will make huge changes in the long run. But it's not going to happen overnight. This takes a bit of time to make these changes.
Right, and a great segue into my next question, Tim, which I guess about a year ago we talked about this whole concept of tax fairness and paying your fair share, and we all had different views. I think I even mentioned the flat tax idea. I know Jake was like, yeah, this is not bad. Some countries are using it. I know you had talked about, well, probably my clients don't really mind paying more tax. So you talk about business coming into Canada. We need to obviously create an environment where businesses want to come. So here's the big question. Do we need to cut taxes? We've seen recently the Premier talk about, cutting interest rates. And I believe the Bank of Canada will cut interest rates next week, but a cut in taxes and a meaningful one. I know Prime Minister, when he came into office, he had a 1% cut in taxes, and I don't think that's enough to buy me and my family dinner one night. But do we need something more meaningful to help stimulate our economy, to make it so businesses want to come here, to make it so we have more money in our pockets at the end of the day to spend in the economy, to go out and buy flat screen TVs or whatever we want to do? So do you think we need a meaningful cut in taxes?
Would you like me to give you my thoughts?
Tim, that's for you.
Sure. We can't lose sight of the fact that we live next door to our very large cousin, the United States, and we have to pay attention to what they're doing from a tax perspective. There are some things that we do which I like better, but in a lot of ways, businesses will take a look at the tax regime in both countries, and and they'll make decisions about where they want to locate. And tariffs have something to do with that, of course. But at the same time, we can't be uncompetitive when it comes to corporate taxes and personal taxes, so much so that we lose talent and capital investment. We just can't do that. Like the capital gains tax changes that were proposed last year, which of course never came to fruition, were just a perfect example of the kind of thing that just would scare away more investment. It boggles the mind that could even cross the mind of those in power. But at any rate, Fortunately, that didn't happen. I do think we need to take a look at where we stand. And I think tax cuts are probably part of the answer, not the only answer. I will say that the 1% tax cut that the federal government brought down is just a token. And I know that adding a $30, more to a Canadian's bank account every month through that is not going to change the world. It's not going to make much of a difference. They just want to be able to say they cut taxes, right? So it has to be more than just rhetoric. It has to be meaningful and targeted. I won't get into specific ideas, but there are ideas out there.
Yeah, for sure, for sure. And Jake, you mentioned obviously you're right about tax cuts and how much we pay in income tax being our largest, money out, if you will, for families. All families' expenses probably don't add up to the amount of tax we actually pay on our income. So what do you think? What would be meaningful for you? A 10% cut right across the board, business tax cuts, personal, both? What would be what you would want to see?
Yeah, I agree with what Tim said. I mean, I think we need meaningful change on tax rates, not just, kind of tinkering around the edges with, one tax rate going down by 1 percentage point, for instance. Like, I think looking at the model that the Gordon Campbell government had in BC in the early 2000s, for instance, they had a precarious financial situation, but at the same time, they actually reduced personal income tax rates by 25% across the board, for instance, at every level, while also making changes to the corporate tax rate structure in the province, and also flatlining spending at the same time too. So they were doing a lot of things and also making changes on the regulatory front to remove 1/3 of the regulatory commitments in the province too. And they had one of the better per person economic growth periods in Canada after making those changes. So I do think we have to be quite bold. Now is not the time to just kind of maintain the status quo and make tweaks here or there. They are going to be difficult decisions to make, and they are going to require you to cut back on spending and other initiatives that you want to take on. But the opportunity cost of you not going down that route of not reducing taxes, I think, is far greater than the decision to do so. I mean, like Tim said, we need more investment. We need more capital in the country. We need to keep the talented individuals in Canada or attract them here. And right now, we're not doing that.
Yeah, no, I agree, and very much so, as the three of you know, and trying to, I guess many are trying to go to the Prime Minister and saying, hey, listen, I think taking a look at our tax and how we're taxing individual businesses, it needs to be looked at. I know Tim mentioned our neighbors to the south, and obviously in the last year, the One Big Beautiful Bill was passed. And that included extending the Trump tax cuts from his first term, but it also included things such as no tax on tips, no tax on overtime, allowing businesses to have certain write-offs in their first year. So I ask you, Fred, what do you think about the One Big Beautiful Bill? Do you think we need to take a page out of something like that? Do you think we need the Canadian One Big Beautiful Bill and to bring some cuts in certain areas of our economy?
Well, I think the One Big Beautiful Bill is actually a bigger threat to the Canadian economy than the Trump tariffs are. And I think the government, I'm sure the government is seized with that. They're looking at tax competitive with the US, and that should be addressed in the upcoming fall budget. We'll have to wait and see. In terms of tax measures, I think it would be hard and probably a mistake for Canada to try to go toe to toe with some of the tax incentives that are in the One Big Beautiful Bill. The government's in a difficult situation right now, and we'll see that budget day as well. We know there's a lot of red ink, so they're trying to address that partly through what Prime Minister Carney has referred to as austerity, at least in French. We'll see what that austerity word really means when it comes out. We know about restraint in direct federal spending, the 15% cut over 3 years and so on, which is probably not sufficient in terms of addressing the deficit and the growing deficit when you match that up with growth in spending, just in national defense alone, for example, and in other areas. So the timing is very difficult for the government to consider across the board tax cuts. What I would like to see happen is the government follow through on one recommendation that it made in its election platform, the Liberal Party, and that was a comprehensive review of the corporate income tax system. I would like to see it cast more broadly than that to include all taxes. Really, what the government needs to do is look at the source of revenue, the source of financing, and come up with smarter ideas that don't discourage investment and do encourage more economic growth. So, in the context of income taxes, look at the top marginal rates and the threshold levels of income and so on, both the personal level and the business level. I say the business level simply because, we have the small business deduction, and I don't want to be seen as going on the record as opposing the small business deduction in any sense, but there's a huge gap between that and the standard corporate rate. And that is distortionary in nature. We need to attract capital investment. Large multinational firms are the source of a lot of that investment. And so we want to encourage them to come to Canada as opposed to other countries because that's where they've been going, because their rate of return is higher there. Similarly with consumption taxes. Again, I don't want to be seen as advocating an increase in the GST. Some economists have done that. I don't necessarily disagree with that. I mean, for the simple reason that, as I said, look at the tax mix. Income taxes are the most distortionary. They have the highest deadweight loss in terms of, the impacts that they have. So start to move in a direction that Prime Minister Carney has articulated, spend less, invest more, and do some of these tax changes that would encourage movement in that direction.
Yeah, and well, as I always say, make it a nice place to do business, and hopefully business will come. And Fred O'Riordan of EY Canada, Jake Fuss of the Fraser Institute, and Tim Sesnick of our family office. Thank you so much, guys, gentlemen, for joining me again 1 year later. It was great to get you back again, bring the family back together again. And who knows, maybe we'll get together again, and who knows what that environment will be looking like when we do again. So thanks once again for being on our show, and look forward to seeing you guys again soon. Take care. What a great interview. Three tax experts. I say bringing the guys back together again. Three excellent viewpoints, slightly different in their businesses and who they work with or who they work for themselves, etc. Just a fascinating interview, a wealth of knowledge from all three. So once again, thank you to the three gentlemen for participating in our tax panel. Now the part of the show where I talk about three things that individual investors should be considering before they make their investment decisions. And here you have the three I want to touch on today. Fed rate decision and commentary. We know the Bank of Canada already cut a quarter point this morning at around 9:45 this morning. The Fed will announce their rate decision 2 p.m. this afternoon. Chinese and U.S. talks and geopolitical events. We know that President of China, President Xi, and President Trump will be speaking on Friday. I think a lot of that talk is going to revolve around TikTok. I know that the U.S. is trying to acquire TikTok from the Chinese, including the algorithm that goes along with it, which makes TikTok so enticing. But I think there's a lot more to that. And that's not just a TikTok conversation. I think it's a trade conversation. So we'll talk a bit about that. Has the Mag 7 hit 20 trillion in market cap? The answer is yes. Recently, the Magnificent Seven reached 20 trillion in market cap, actually over 20 trillion. What's the significance of that? Well, the US economy is 30 trillion. So 7 companies make up 2/3 of the US economy, bigger than the next largest economy, which is China, in and around 19 trillion. So if those 7 companies, Mag 7, if they were a country, they would be the second largest economy in the world today. What does that mean? We'll talk about that as well. Let's move to the first one that we have, first topic, which is the Fed rate decision at 2 p.m. It is assumed that we're going to get a 25 basis point cut. And I think that's pretty much a given. I think the market could perhaps sell the news, if you will. So they buy the rumors and they sell once it's announced because the market has already factored in that 25 basis point cut. If the Federal Reserve were to reduce rates by 50 basis points, You may or may not, obviously, get a better reaction from the market. You could get a better reaction because they're cutting interest rates more, or you might get a negative reaction because maybe investors are going to say, well, maybe things are slowing down with respect to jobs and the economy in the US even more so. Maybe those in the government are not telling us just how bad things are moving. So if the Fed cuts 50 basis points, that might be a negative, or maybe not. We'll have to see. All eyes and ears will be on the Fed and their announcement at 2 p.m. this afternoon. So just over, I guess, what, about an hour and a half's time from now. Our first report, or first chart, I should say, comes. It shows actually the bit of a pickle that the Federal Reserve is in. It shows U.S. Consumer Price Index. There it is. And I say a bit of a pickle because inflation is rising. We're getting data, PCE and now CPI. PPI actually look good, but CPI clearly is showing that inflation is now back in and around 3%. Headline number 2.9. The core rate, which excludes volatile energy and food, it's at 3.1. So inflation, 3%. Keep in mind, Federal Reserve target is 2%, just like here in the Bank of Canada, target is 2%. So if they cut rates today, they're going to be cutting rates with an inflation rate that is well above their target rate. Unlike Canada this morning, that cut interest rates with a target inflation rate of 1.9%, below that 2% level. Next chart here shows the month-over-month increase, and you can see how much inflation has jumped up. CPI jumped up 0.4%, well above anything that we saw, I guess, dating all the way back to maybe even January. You'd have to see a number that high. So inflation is rising, and some people are saying maybe the Fed shouldn't be cutting interest rates when we have, or when the US has, perhaps starting to see a bit of an inflationary issue. But the one thing that the Fed is focused on and why they're going to cut interest rates is because of our next chart, which is the monthly job change. And you're going to see that this past month, 22,000 jobs created, well below what the expectation was, which was somewhere around 75,000. We saw in the month of July, again, 79,000, well below the expectation. And then you had the two big revisions, right? Two big revisions, 19,000 for the month of May, and a negative number for the month of June. So that is what the Fed is focusing on, and the main reason why that you're going to see a 25 basis point cut come 2 p.m., or at least so we believe. Next chart, unemployment rate, that's coming in at 4.3% now, and you can see how much it's gone up just since 2023. Another chart we've seen this before, shows the economy at a glance, and we're seeing now, there it is, 4.25, 4.50. This is where the Fed funds rate is right now, and it is well above, still well above the inflation rate of around 3%. Plenty of room for the Federal Reserve to cut. So keep an eye on what the Fed says at 2 p.m. today, but also keep an eye on the various commentaries that will come out in the days after today. And I think that will give us a pretty good indication as to where things are going. Our second topic that I think individual investors need to focus on, it revolves around the geopolitics, the trade talks between, in this case, US and China. We know that the president will be speaking to President Xi of China this Friday. And a lot of those talks, yes, will revolve around TikTok, but I think it's going to revolve around trade as a whole. Why is this so important? Well, TikTok is pretty big, a pretty big deal for many in the US, many in Canada, Europe, Asia. TikTok has become a very important social media platform, excuse me, for many. And we have some statistics to clearly show this. Our first chart actually shows the sentiment around TikTok right now. And you can see it's pretty much divided. Once upon a time, we had a lot of support for TikTok. That has come down. Many that opposed it were, in that, I guess, 22% rate area, and that has come up. And then the not sures seem to have stayed pretty stable. So a lot of people believe that TikTok should be available in the United States, and the president wants to make that happen. Our next chart shows TikTok users by region, which is quite interesting. You'll see the Asian Pacific area is by far the largest users of TikTok. Second is actually Europe, even more so than North America. But nonetheless, North America, US, is a big user of TikTok. Social media apps. What are the apps that people are using? Where does TikTok fall in that mix? Interesting enough, 3 of the 4 largest social media apps are actually from Meta. Yeah, Facebook on top, just over 3 billion users on Facebook. YouTube, which is a Google or Alphabet product, 2.7. WhatsApp and Instagram follow. And then you have TikTok, just under 2 billion users, active users. So you can see that TikTok is a very large and important component with respect to social media, where people get their information. More and more individuals are going on the TikTok platform. But as I said, make no mistake about it, this is going to be a conversation between the US and China on trade. Maybe China says, okay, we'll allow you to buy TikTok from ByteDance, a Chinese company, and in return, what are you, the United States, going to give China? Maybe it's access to better chips, better performing chips, more powerful chips. Maybe it's something else that the US will have to give up or be told they must give up to get TikTok and the algorithm for TikTok into the US. So Friday, big day, in my opinion, could be a market mover. It will be a conversation between the two heads, the head of China, Xi Jinping, and the President of the United States, Donald Trump. Definitely something individual investors need to focus on. Our third point and last point for our show today is the Mag 7 and just how much the Mag 7 makes up of the markets and why it is so important for individual investors to think about owning, especially looking for growth, a piece of the Mag 7. And our first chart shows how much the Mag 7 is worth right now. As of September 12th, 19.95 trillion. So just under $20 trillion. These are US dollars. And if we go to the next chart right away, you can see as a few days later, it went over the 20 trillion mark. And those are the market cap of each of the Mag 7. You can see NVIDIA is now by far the biggest company in the world, biggest company of the Mag 7. But Alphabet just recently joined the $3 trillion market or $3 trillion club. And to me, what I think and the takeaway for investors should be this. What is driving the bus right now is clearly technology. Clearly, the Mag 7 are at the forefront of most of what is happening right now, making up 2/3 of the US economy. They are the biggest companies. They have been some of the best performers. And if you want to add other names there into the big cap tech space, like Broadcom, which is now worth over $1 trillion, but other names like AMD, another chip maker, and many other data storage companies or other companies that have or do business and offer AI, artificial intelligence, and incorporate AI into their business. This is where individual investors, I believe, need to start focusing on if you haven't already. Now, you want to stay diversified. You want to have a nice, diverse portfolio. But in my opinion, if you're looking for growth, this is where your search should begin and end. Because in my opinion, technology today is definitely driving the bus. So inflation, we talk about it all the time. We all expect prices in the US to keep rising. Inflation in the US has gone, tariffs in the US has caused inflation to go higher, but it never got as high, or at least not yet, as high as many people thought it would, which is quite interesting. Why aren't prices going higher? Why isn't inflation showing up at a higher rate? And that is quite interesting. And it's interesting because of who is covering the costs of these higher prices. When tariffs are put on goods coming into the US, who is swallowing the higher costs? And what we're finding is, in a lot of cases, it's the businesses themselves. They are swallowing a lot of those costs and passing on only a small percentage to the end user or the consumer. And this is quite interesting. Our first chart, actually, which is a great one, shows all the different tariff rates. And you can see here on the left side, Mexico, for example, share of US imports, 15.5%, but you have a tariff rate of 25%. You can see Canada's rate, our tariff rate, 35%, and so forth and so on. India, 50%, but the share of US imports, a small amount, only 2.7%. So here you have all the different tariff rates. And what the main takeaway is, look, if you had to get an average for all these countries, what would that average be? Well, our next chart shows what that average is, and that average falls in the vicinity of 15 to 20%. There you go. You can see the tariff rates, the average effective tariff rate since January 2025, and where it sits right now. It was obviously higher earlier in the year, in April, but since the trade negotiations happened over the summer months, a lot of the tariff rates came down. And so now we see an effective rate somewhere around 18%. Keep in mind, look on the far left of this chart. Look where tariff rates were a year ago. It was something like 2.5%, 3%. And today, much, much higher. So what's going on with these tariffs? Well, as I said, if you're looking at a country that perhaps has a 15% tariff rate, what we're finding is that first 10% or so is being swallowed up by the companies. They're swallowing it. It's a hit, obviously, to margins. It's a hit to the bottom line, but they don't want to pass on that full cost to the consumer. Then with the last 5%, if it's a 15% tariff rate, that 5%, that is basically being shared by the business and the consumer. So maybe they'll pass along 2-3% and cover another 2%. So effectively, they might be covering 10 to 12% of the 15% tariff. That is the business. And maybe the consumer they're seeing their costs rise about 3%. And that's what we're sort of seeing. Our next chart that we have here, which is the company's reactions to the tariff by regions of the world. You can see here exactly what I'm saying. Withdraw or cut in guidance. So this is US companies that are saying, because of the tariffs, we can't tell you how much we're expected to make over the next 12 months. And you can see how many companies in the US are saying that. You can see how many companies are instituting price hikes, how many are having a financial hit to their bottom line, profit margin warnings, etc. So you can see what's happening in the US. It's also happening in the UK, emerging markets, Asia. But in the US themselves, the US is the ones that are putting on these tariffs, and yet they're the ones that are seeing the effects with respect to hits to the bottom line for their corporations. Our next chart actually shows by sector of the economy, and you can see here, automotive and transportation, withdraw or cut in guidance, 18. Financial hit, 14. The consumer, look at the consumer. They're being affected, obviously, not as much as they could be, and that we were fearful that it would have been. But for now, businesses seem to be swallowing up a fair bit of the higher costs. You can see healthcare and industrial manufacturing is another area that we're seeing businesses really, I guess, swallowing the costs of these tariffs. So if you're wondering now, okay, well, if businesses are swallowing the majority of the tariffs, how long can they do this for? Is there an offset for these higher costs on one side? Could they be cutting in another area? Well, as we have seen just, I guess, a segment or two ago with respect to hiring and jobs growth, that is the offset. And what we're finding is that businesses, they may not be firing individuals right now, but they're not hiring. So any business, especially if it's a big business, on average, you have a number of individuals retire at the end of the year. We know that the workforce in the United States and Canada and around the world is aging in most countries. India is probably one of the exceptions to that rule. So as people are retiring, we find that businesses are just not replacing them. So they're not necessarily letting go individuals, but they're not hiring. They're getting more efficient. They're asking people to do more than what they were doing in the past. And on top of all that, we also know that artificial intelligence is definitely helping businesses start to become more efficient. We're going to see AI play a bigger and bigger part in terms of efficiency, and unfortunately, perhaps a cut in employment going forward. So overall, what I believe you're going to see and continue to see are businesses and a cut in employment. And that's why I think, or that is what I think is offsetting the higher costs they're swallowing with the tariffs. We have a chart, U.S. job growth lower than expected in August. And you can see there it is, the red little dot there. We showed some information earlier, but yes, that goes along with what I'm saying. We are not seeing people being hired. Next chart shows exactly this. Fewer jobs than job seekers. There you have it. The unemployed are now catching up to the job openings. We get this number out of the US every month. It's called JOLTS, and it stands for job openings and labor turnover. And that JOLTS number is coming down seemingly on a regular basis now. And so job openings, unemployed, have now surpassed job seekers. There's not as many job openings as we would like. So overall, what we're seeing is that jobs are not being created, or job openings are coming down, and businesses are using that to offset swallowing a lot of the tariff costs and the higher costs. And we'll just have to see how long these businesses can maintain this sort of thing. So all eyes were on the Bank of Canada this morning, and I'm happy to say we lowered interest rates in our country by a quarter point. Was that a surprise? Definitely not. When you look at the slowdown in our economy, we're seeing exports slowing down by just under 30%. We're seeing business activity down by 10%. Slowdown in GDP. Jobs growth has been negative. We've lost almost 110,000 jobs over the summer in the months of July and August. We're seeing negative right across the board right now, red everywhere. So should the Bank of Canada not cut interest rates? Well, if it's what the Prime Minister and Premier Ford says, it's all hands on deck, we need to do whatever we need to do to stimulate growth, then yes, an interest rate cut is definitely needed, and we saw it earlier today. And I'll go out on a limb and say I would consider cutting again in October, and maybe even one more time before the year is up. So we could see another cut, maybe as much as 2 more cuts, depending on how the data shakes out, especially with a 1.9% inflation rate. So let's move to our first illustration, Canada's inflation rate. And you can see there, 1.9% is the headline number. And if you look at some of the other data, taking into account what we call the CPI median and the CPI trim, these are other things. These are core numbers. It actually bumps up to about 3%, gradually moving higher, but the headline number seems to be staying in and around 2%. Our next chart shows Canadian employment change, and you can see what I just said, over 100,000 jobs, 107,000 jobs to be exact, were lost during the summer months. We want to see job growth, not job loss. And that, to me, is a big factor in why the Bank of Canada cut interest rates this morning. Our next chart, Canada's unemployment rate in August rose to 7.1%, highest we've seen in a long time. You'd have to go back to, I guess, 2000, before 2022, 2021, 22, to see a number in that range. We've been hovering mid sixes for a little while, and now we've gone over 7%. So it is obviously not going in the right direction. The next chart we have is Canada's GDP. And once again, you can see we had negative GDP, negative 1.6%. The estimate was a lot better than that, but 1.6% GDP negative is not what we want to see. So once again, more negative numbers, more red that we're seeing with respect to the data. We need to do whatever we have to do. And I will go out as to say, and I've been a big proponent of this, as many of you know, and we just had the tax panel on earlier, What about a cut in taxes? To me, that is what we need next. Maybe Prime Minister Carney's watching our show today, and he'll consider cutting taxes, because I think that goes hand in hand with a cut in rates. Our next chart, our last chart, Bank of Canada policy interest rate, and you can see here where we sit. And after today's cut of a quarter point, we sit at 2.5%. So what the Bank of Canada did this morning, definitely not unexpected. It was totally expected. The question now becomes, what do we see going forward from the Bank of Canada? Quick hits. These are three things that I think caught my eye anyways over the last couple of weeks when I looked out into the news. And as always, I'll try to give some commentary on them. First one, U.S. retail sales increase in August. U.S. still continues to show growth. It's unbelievable. No matter how much is out there with respect to worrying, with respect to tariffs, higher costs, trade, the market just seems to climb that wall of worry. The consumer seems to continue to spend, and August was no different. NVIDIA violated anti-monopoly laws, says China. Many of us believe that that's just China trying to push back on the United States with respect to trade. And our third point or quick hit, national home sales up nearly 2% in August in Canada, which is important because our real estate market has been quite, let's say, subdued for a little while now. So let's move to our first quick hit. U.S. retail sales strong in August. We can put up our first illustration, and that shows that August grew 0.6%, 732 billion, up from a revised number in July, but they were both up 0.6%. Very strong numbers. And percent change in retail and food and services on our right side there from the previous month. You could also see retail sales has never floundered. It's been strong in the United States. You couple that with higher inflation, you couple that with higher GDP, and GDP in the US for the next quarter is expected to be quite good as well, in and around 3%. So that is the counter argument to the Fed cutting interest rates. But once again, the Fed's mandate is jobs, 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 jobs. So because jobs growth is slowing, the Fed will probably cut come 2 p.m. Our next quick hit is the one regarding NVIDIA. They violated anti-monopoly laws, says China. I don't agree with that. Unfortunately, NVIDIA is following the lead or the instruction from the U.S. government. And apparently, they when it purchased a network and data transmission company called Mellanox Technologies, they are being accused of anti-monopoly laws. Again, it's just, in my opinion, an excuse to tell a lot of Chinese businesses not to buy chips from NVIDIA. And that's what the Chinese government is telling businesses to do right now. We have a chart on NVIDIA. You can see that NVIDIA stock has done extremely well. It's come off its highs recently, in and around between 170 and 180 that it's trading at right now. I think perhaps this might be the pause that refreshes, and perhaps you see NVIDIA stock go over 200. Our third and last quick hit, national home sales up nearly 2% for the month of August. This is a breath of fresh air. We have a chart here on home sales in Canada, and you can see that for quite some time, the 10-year monthly moving average, you can see the solid line there. We've been below it for quite some time. We seem to be now moving back towards that number once again, and that is a breath of fresh air. But as I know, in talking to a lot of home builders and a lot of individuals in the real estate and home building market, as I said this morning on CP24, these individuals are really suffering right now. There's not a lot of homes being built. It's just not economical to do it. So even though we're seeing home sales up in Canada, new builds are definitely still lower than what we would like to see. So what's my take, or what's your take? I love that. It's a part of the show where we get to answer as many questions as we can. And because we had a great long interview from our tax panel, I'll get to one question today. And I think it's a pretty good question. And it says that this person feels that the market is a bit hot right now with, the indices at all-time highs. Do you recommend clients actively increase their cash position? So selling off their profits in these companies and holding cash, or do you feel as though there's still room to grow? Well, a lot in that question, but I guess I'll answer it by saying this. You can never time markets. For those that want to move to cash to eventually buy back into the stock market, that is a difficult thing to do. Many have tried, and unfortunately, few have been successful. So timing markets is never what I recommend. Do you want to take some profit off the table, maybe trim back some of the growth in some of the names right now? Absolutely. And then take that growth or that money and maybe move it into something else. Maybe you move it into cash, but just temporarily. Because as we know, high interest savings money, cash, fixed income, these are things that are paying very low in terms of interest, maybe 2-3%. And as we know, that just keeps up with the price of or the cost of inflation. So to me, I think you stay invested. I think you trim some of the winners if you have winners in your portfolio. And I think you're always massaging or shifting around money in a portfolio. Take some of that profit off the top that you skim and move it into another area. And that's what I do, especially if we do get a bit of a market downturn in this latter half of the month of September. So with that, I want to say thank you to everybody who tuned in to our show today. Hopefully you took away something positive, something that perhaps you didn't know before, and answered some of the questions that a lot of investors have today. I want to say that I hope all of you are back in 2 weeks' time on Wednesday, October 1st. Yes, October 1st. Wow. I can't believe we're already close to moving into October at 12 noon. And until then, as I always like to say, happy investing.